Okay, welcome to our February 2026 podcast. And as always, the format that is what is on the mind of investors. And what we generally do is we answer some of the more frequently asked questions that we're getting from clients over the previous month. And that's why it's great to have the guest speaker that we have today. It's such a great fit. Today we're happy to have Meera Pandit, and she's with JP Morgan. And she's part of their global market. She is a global market strategist on JP Morgan Asset Management's Global Market Insight Strategy team. So, Mira, we'll have to ask you to tell us what that is. But the reason why I said it's such a great fit is Dan and I were looking at your website at JP Morgan Asset Management over the last couple nights, and we see that you have a whole section in there that you produce content. It's called On the Mind of Investors. So that's exactly what the podcast is designed to do. I don't know, Dan. Maybe we should have got that copyrighted or
You
something. I
should
didn't
have.
know other people. I didn't know,
Be a more
but
litigious
Mer,
podcast, but between us,
Exactly.
right, that's
nonetheless.
right. I think you guys might win that battle, so we won't do it. But so briefly, Mira is responsible for delivering timely market and economic insight to institutions and retail clients, and conducting research on the global economy and capital markets. And as you know, that's what we're focused on here. Um, she is a contributor to publications such as Guide to the Markets, and for the clients out there, the charts that Dan and I always fight about every month that I want to include 20 charts and Dan wants to include two charts. They're typically from the Guide to the Markets. That's Mira's group that puts that together. She's been with JP Morgan for 15 years. And been a frequent guest on Bloomberg, Yahoo Finance, CNBC, CNN, and other financial news publications. So, Mira, thank you very much, first of all, for attending, for joining us today.
Thank you for having me. Excited to have both the ons of the minds of investors meet today.
That's great. We'll have to merge the two units
Mhm.
together. First thing, would you mind sharing a bit about what the global market research team does at JP Morgan?
Sure, people are always asking what's in the crystal ball, but the reality is it's not about seeing and predicting the future. It's about seeing the present with clarity. So we do try to simplify the complex when we think about markets and really have a framework for how to look at both markets and the economy globally so we can help to make better investment decisions.
That's great. And I'm shocked. I don't know how many people you have. These charts that you put together and the guide to the market. We eat those up every month. I mean, but there's hundreds of charts. What kind of staff do you have putting that content together? Is it
You
just
know,
you?
it's just me in the
Yeah,
boiler
you're
room.
right.
We
Right.
have about a 30-person team globally. So we have about 10 people in New York. We have someone in Taiwan and in Paris and in Sydney, all over the world. In terms of the actual guide makers, there's really about three people. So they're doing
Wow.
a lot of heavy lifting in terms of getting the guide out. And it's not just a quarterly publication. We change the content quarterly, but every single morning we're putting out a new guide to markets to make sure that data is updated because the markets are moving so fast. It's actually something we started to do right before COVID, and the timing couldn't have been better because markets have just swung so wildly in recent years.
That's great. No, it's a great publication. So, Dan, you're our resident technology guy. So, why don't we kick it off and talk about some of the AI questions we've been getting recently?
Yeah. So I think, and thank you again, Mira. This is just such a treat for us. But this has been a persistent theme over the last handful of months with our clients. But it seems like every single month, number one question is, what's going on in AI? Is this a more of a thematic multi generational boom, or are we in kind of a bubble type situation similar to say 1999, for example?
We've gotten that question a lot, really important to think about. And like I said, our team tries to think about frameworks around some of these big investment questions. So recently we put together a piece on our On the Minds of Investors called Evaluating the AI Boom, EVAL. And that's the framework I use to think about the AI boom. And we do think it is a longer term secular boom, not a bust. And when we think about the different components of what underpins its strength, E is the number one thing, earnings. That's a huge differentiator between now and the internet boom and then bust, in that these companies are insanely profitable. You look at just the Mag 7, which are not encompassing of all of the AI names, but they were sort of at the forefront of this AI and tech wave. And they have had double digit earnings growth. since the launch of ChatGPT. For the last couple of years, really just spectacular earnings. If you also look at what they're doing to monetize AI, in the third quarter, where we have full results for all the hyperscalers, you had 27% year over year cloud growth. So you're also seeing results in the numbers probably quicker than most prior technological innovations. And then you look at the future, we've seen upward revisions. We continue to see a consistent level of above trend surprises in terms of earnings. And so the past, the present, and the future of that profitability has been incredibly impressive. Then we think about the valuations. If you looked at the tech stocks back during the internet bubble, the peak valuation was about 70 times forward earnings. Right now, the Mag 7 are trading around 28 times forward earnings, maybe a little bit less since there's been a little bit of a challenge more recently. So, is that expensive? Maybe. But is it excessive or exuberant? Absolutely not, especially when you think about that profitability they've been producing. Then you have to make sure in any of these big trends that there is underlying demand. So, A in eval is adoption. And you are seeing companies increasingly adopt. And it's not just the average individual who's like downloading ChatGPT and writing sonnets for their grocery list or whatever it might be. It's actual enterprise adoption where people are using this technology to become more efficient. And I know you guys were talking a little bit about the slide in software as we were warming up here. I mean, you're seeing that as a really a reflection of this threat of how much adoption is going on with AI from a business standpoint. And then the last point I'll make is L leverage. A lot of times you see booms go bust because there's a credit event. There's a credit crunch and it becomes challenging for companies to sustain their their business models essentially because the borrowing got over its skis. And what you're seeing right now is those big hyperscaler spenders of all this capex have actually maintained net leverage that is less than the average S&P 500 investment grade issuer. So these companies have the balance sheets. Even if they are increasingly tapping the bond market and different financing structures, they could pay for it in all cash. And remember, a couple of years ago, we were like, why do these companies have so much cash? Like, they should either give that back to shareholders or they should do something with it. So
Yeah.
now they're doing something with it. So I think the decline in free cash flow that we're seeing with those companies is actually a positive thing because they are investing in something really tangible for the future.
If we kind of go back in time, a few months back, yeah, I believe it was the first story came out with Google, right, tapping the bond market for the first time, not using just pure free cash flow. So, in your estimation or J.P. Morgan's estimation, there, it's kind of much to do about nothing. If you saw that trend to continue and maybe, progress further in terms of repeatedly tapping or increasing the size of their outreach into the public bond markets, that might be cause for concern. But right now, it seems like the debt loads are manageable.
It's funny in some ways, some of these companies tapping the bond markets is making the bond market stronger because your issuers are stronger and actually the
Yeah.
credit quality then actually sort of improves de facto. But I think the bigger credit concern is the fact that not everybody's a hyperscaler, not everybody's a Mag 7, not everybody has these enormous cash balances and can take the risks to make a mistake. If Nvidia makes a mistake, they'll probably survive and then some. But you think about some of these other names within the AI tech space or around AI infrastructure, and that's where you just want to be a little bit more mindful that companies that maybe don't have as healthy of balance sheets or as strong of cash positions are doing borrowing. So there is some broader risks around that as opposed to some of these big names.
Merit, so just kind of timestamp this podcast. We're in the 4th of February on a Wednesday. And what's been happening just really the last couple of days, we're seeing a real sell off in the software stocks. I'm looking at on the screen here, Microsoft down about 25% from its all time high. Salesforce down like 44%. Is it going to be, should we expect kind of a zero sum game where, some of this software stock, they're going to be losing market cap to just the AI companies?
I think we've moved from the winners phase where 2023, 2024, you had all of the AI stocks just go up and to the right. Everything did
Right.
fabulously well. No differentiation, even in terms of who was doing what. But now you're getting a lot more differentiation, not even within the Mag 7 themselves, but also outside of that in terms of who are the winners and losers. What I will say about software is yes, I can see on the surface why they would be a loser. But at the same time, you think about AI as more of a platform, a foundation for some of this software as opposed to full sale replacing it. If I think about having access to AI capabilities, I don't want to spend all day thinking through how do I program the right HR software or the right chart software for myself to replace all the existing software that I have. Because it's not only the software that's being provided, but it's the expertise in how to do the plumbing behind the software. Like there are experts here who say you need these fields and here's the user interface and here's how it flows from part A to part B. Like I can't do that for every aspect of my job, let alone my life when it comes to AI. So I certainly think it's a powerful technology, but you still need the expert lens on that. And I think that's where the software providers can really differentiate that I don't have to build a proprietary software that maybe isn't as well thought out or structured as what they would build. But no matter what, it's probably going to be underpinned by some AI capabilities as things evolve.
And I would just piggyback on there for a second. As we see kind of AI move from its initial phase, right, of capex build out, and broadening adoption of LLMs, to now kind of agentic AI, and eventually artificial general intelligence. Do you think that software companies will kind of be beneficiaries of that agentic AI kind of next evolution, or do you think that new players out there will kind of step in and might be the under the radar kind of tech companies right now that are really going to rise up to meet that need?
It'll be both. I think when software companies are smart about how they're innovating and how they're partnering as opposed to trying to straight compete, that
Yep.
can help certain areas that have the vision. Whereas there's going to undoubtedly also be names that we've never heard of in the next couple of years cropping up, especially in the next couple of years, because this is such a fertile period for AI. And we've moved beyond the heavy concentration phase where it's only a few companies that are able to innovate and are innovating. It's now starting to be a little bit commoditized on the margins and also start to bring in more companies that are going to innovate on top of the basic technology and the basic innovation. So I think it will be a little bit of both. Certainly new players, but it's all about vision. And when I think about how what we've seen over time with technological innovation is that the leaders of today may not be the leaders of tomorrow. That is something that we have seen time and time again with companies. We have a great chart in the guide that shows exactly that. It's not like, oh, well, someone's going to go bankrupt tomorrow. It's also about losing vision. There's so many companies today that are still stalwarts of a portfolio, but I would also categorize them as almost blue chip graveyard, where you're going to have them in your portfolio no matter what, but they're maybe not the high octane, interesting opportunities. So I do think there is a risk for some of these large Mag 7 companies to kind of lose their way, lose their vision, and just become part of the landscape, but not the forefront of the landscape.
Wow. And moving beyond, talk about the broadening out of the market, moving even beyond AI. You have a great slide on the guide to market. And we share this frequently with clients, and the title of it is Returns and Valuation by Style. And it shows that old Morningstar style box. But if you look at it year to date, again, this is just through January. We're seeing something we haven't seen in a while. The top of the heap there is small cap value. So for the month of January, you saw small cap value box was up 8%. And believe it or not, large cap growth was down 1.2%. So that's quite a change. And so value beat growth for the month. Small beat large, which is unusual. Certain funds that we use, for example, like Dan, the Schwab high dividend, which is SCHD, or Java, which is JP Morgan active value. I mean, they had great months too. Large cap value funds. Schwab is up like 9%. Java's up near 6%. Should we expect that to continue into 2026? What are your thoughts there?
So I was just looking at my screen year to date to see what that bridge is between large cap value and large cap growth. And you
Right.
had outperformance of large cap value right now of about 10 percentage points. So that's a
Wow.
massive
Yeah.
outperformance relative to what we're used to. And what I would say is I don't necessarily know the gap will remain that large, but I do think we are ripe for a rotation. And when I look at some of the sectors that are doing well this year and why, I've thought about three themes. One is geopolitics because you're seeing areas like materials do very well.
Hmm.
And underneath that, it's a big metals and mining story. So there is that geopolitical bent to it. It's also a bit of an AI story when you think about materials and commodities used in AI. You then look at this AI rotation where we're moving from just a small number of tech companies to the broader tech landscape. So last year, of the best 50 performing companies, 20 of them were tech, but only one was a Mag 7. And then you look at
Wow.
the broader landscape outside of that, where another 18 or so companies came from industrials, materials, utilities. So again, that's your AI play in terms of the power and the infrastructure. All three of those sectors in the third quarter had double-digit earnings growth. We're still seeing things come in for the fourth quarter. And financials also did pretty well, but that's sort of a side note unrelated to AI. Now, when I think about some of the drivers this year, you have this monetary easing bias where you're probably going to see the Fed cut modestly and round out their cutting cycle. And then you look at the fiscal landscape, you have the One Big Beautiful Bill Act that is likely to not only boost the consumer because they're going to get $700 or $800 more than they usually do in tax refunds and probably spend that. And you also have the One Big Beautiful Bill impacts to businesses, where some of the um, bonus depreciation, accelerated R&D, basically is going to shift tax liabilities to the future, improve some of those free cash flows to the present, and that could then lift some of the activity in some of these capital intensive sectors. So again, you're seeing in energy, materials, industrials, the top performers so far this year. It's from an energy standpoint, not the oil story. Oil's not moving all that much, but it's really about the equipment, the servicing. And then even within
Hmm.
industrials, it's not even just the AI, but it is all the construction, engineering, machinery. It's an up and down story there. So I think some of these cyclical aspects are certainly going to help, which gives rise to some of those value sectors this year that maybe have underperformed in recent years relative to tech. And some of them again are AI related, some of them are not. So it's kind of a nice mix there.
Thank you. That's good. And I think it's a good thing for clients to broadening out. We typically have clients that are in retirement and, living in a world where it's just seven stocks contributing, most of the gains is not, it's not a great way to live in retirements, particularly when they do have almost in a lot of cases, an equal parts in value. So that's positive for our retired clients.
No, absolutely. Having a highly concentrated market is one highly unusual. The
Right.
40% concentration you have in like the biggest 10 stocks today is nearly unprecedented. Maybe at some point in the 50s, 60s, 70s, you might have seen that level of concentration, but certainly not in the last 50 years. And the challenge there too is their valuations are high, which
Right.
again doesn't mean that they're excessive or overvalued or overpriced. But when valuations are priced to perfection, they are prone to correction. So if you have not only that correction, but then you have a correction in a part of your portfolio that's very
We'll talk about those
concentrated,
things.
you're just going to feel that a lot more than you otherwise would in a normal market where the benchmark looks a little bit more diversified. So having these options across the market is definitively, to my mind, a good thing. And it's not just in the US, it's also international. We're seeing these opportunities crop up. So I think that makes for a healthier portfolio.
Great. Thank
That's
you.
wonderful. Now, Mira, just one of the things you had touched on and kind of just a general backdrop in the market with Chairman Powell's leadership coming to an end here over the coming months, and Kevin Warsh being the nominee there. Do you expect or do you see kind of a change in tenor of the kind of demeanor of the Fed? And do you expect that to be a tailwind or kind of a headwind for the markets moving forward?
I would expect that there will be healthy debate within the Fed. And I don't think that's necessarily a bad thing. It's good to have a range of views because then they're really testing their monetary policy. They're really testing their models. When there's almost too much consensus, then it's like, what are the risks that we're not seeing? And I think with the composition of the Fed, that's not going to be much of a problem because there are people on both ends of the spectrum. Now, I don't think this compromises Fed independence as much as there may be fears that it would, because if you look at the 12 voting members of the Federal Reserve, seven of them are serving these sort of staggered 14-year terms. So it's hard to get too much turnover. And then the others are regional presidents who continue to rotate. And what you've seen in 2025 is a couple of more hawkish members rotate on. So that creates a bit of a countervailing force. And then remember that Stephen Myron's position, Governor Myron's position is a temporary one. The question is, how does Warsh come on? Does Powell stay on? Does Cook come off because of some of the legal actions? But even in a most extreme case where Powell and Cook come off, Warsh comes on, you have dovish people that are confirmed by the Senate. You're still like two or three people fighting against the other nine or ten. And I do think that there are other doves on the committee, certainly, but they're dovish in the sense that they want one or two more cuts, not five. So I do think that that helps the whole construction of it, creating a countervailing force. So when I think about whether it's positive or for stocks or bonds, I think it's a positive in that you have seen volatility within the rate market plummet over the last 6 months back to normal. It was elevated
Yeah,
for about 4 years because your inflation spikes, your Fed hikes. What's the Fed going to do next? Now that that's receded, you're basically thinking from a bond perspective, your income component and your rates up or down component. If the rates up or down are somewhat steady and monetary policy is moving into the background, if we have cuts that are few and far between, then it's really just about your income. And so then you can much more straightforward program your fixed income allocation to maximize on income while balancing some of the risks there, because your risks right now are so asymmetric relative to history, where there is a lot more upside if rates move lower than downside if rates move higher.
very interesting. And I guess kind of following up on that a little bit, historically, I think if you looked at policy stance for Kevin Warsh, in the past, he had a little bit of a reputation as a bit of an inflation hawk. Whereas the expectation now is that, perhaps maybe that is moderated a bit or it might be a bit more dovish moving forward. Is it safe to say that's your expectation as well? That, or in the event that we have a sudden uptick in inflation, whether it be from tariffs or some exogenous event, do you think that there's a universe where rate increases potentially could be back on the table?
It's interesting. He has a history of being more hawkish and more inflation concerned. And more recently, he has been biased to want to see rates lower. And I do think the administration was intending to appoint somebody who was also on board with
Yeah.
bringing rates down. The sort of curveball is about the balance sheet and him wanting to shrink the balance sheet, reduce the role of the balance sheet. That could have more of an impact than anything, because the challenge with shrinking the balance sheet is that we've evolved so much that it's kind of like if you put your water in a you enlarge your space, things will the air, the water will move to fit the space. It's hard to contain things again. And that's a little bit what's happened with liquidity in the system, where we have adjusted to an ample reserves regime instead of a scarce reserves. The balance sheet has become a legitimate tool in the toolkit. So to take that away is difficult. If you think about regulation, bank reserves are heavily regulated. So if you wanted to reduce the balance sheet, you'd also be taking regulation away, which is possible. That could happen, but that is one of the other implications differing from prior to the financial crisis. And then you think about treasuries. If we're flooding the market with treasuries, what's that going to do to yields? It would probably push them up. So there are some constraints to how much you want to reduce the size of the balance sheet. I understand maybe they want to change the composition of it, but these all have regulatory, liquidity, plumbing, yield implications that I think the market is more keenly attuned to than simply whether the Fed will cut rates massively.
So a very delicate dance.
For sure. For sure.
Yeah, and it looks like I think as of this morning, they're pricing in still two, at least the betting markets are pricing in two rate cuts in 2026. And is that, I think, and that's JP Morgan's expectation as well, correct?
I mean, we're going to have to see
Yeah.
how the data continues to shape up, because we do expect that our economy will heat up in the first half of the year with consumers getting higher than expected refunds. We do expect there to be some upward pressure on prices given tariff pass-throughs. And again, if people are spending more because of tax money, then they're also probably going to push up prices. So we may not have the need, unless the labor market really falls apart, to see a cut in the first half of the year. Markets are pricing in the first cut for the summertime. So you look at the
Hmm.
futures market, and then maybe one thereafter that I could see being pushed into 2027. So it's one to two cuts, again, few and far between, but that will really hinge upon the overall labor market backdrop staying somewhat stable and steady as it is today. And if we see massive progress on inflation, maybe you bias towards more cuts, but it could take some time to get there.
Great. So, as far as other areas of the market that are moving, if you look again, January returns, continuing the theme of last year, international investing is kind of outperforming the U.S. again for the month of January. It's been a struggle for us, for the clients listening to the podcast. A lot of clients who the last handful of years have wanted to eliminate, international investing for a number of different reasons. Finally, we have clients comfortable with international investing. We put some money back in there early last year. It's looking good so far this year. So let's talk about international investing. Your thoughts there, and also lots of people asking about gold and silver. They've made quite a move. It's kind of hard to chase it at the prices. Although we probably do have opportunities where Friday it was down, gold was down 9%, then 4% again on Monday. So you have those little corrections, but
Yeah, and don't forget silver. I mean, silver had one of the
silver's up.
largest single day moves since I think going back to the 80s.
Yeah.
So it's been a wild ride.
I would say first on international, you're seeing so many rotations in the market this year from growth to value,
Right.
from large to small. You're not seeing that rotation from international back to the US after such a stellar year. And I mentioned you
Mhm.
had double digit, 5, 10, 15, 20 percentage point outperformance by other major markets. And it wasn't a bad year last year for the US. I mean, we were up almost 20%, third year in a row of double digit returns. So
Yeah.
you saw from international, you did have a dollar component where a weaker dollar
Right.
helped, but it was not the only story. You did have a valuations component where valuations continued to be at a deeper discount than normal, and so you saw some degree of valuation expansion. But you also did see legitimate earnings growth, and you we don't always think about international as a dividend market, but it truly is more favorable from a dividend perspective than many parts of the U.S. Given the U.S. has become more growthy and international is more value oriented. So this value trade is taking place abroad, and it has some legs given some of the catalysts. You have AI in areas like China, Korea, Taiwan. I'm just looking at my screen here. Korea up 30% so far this year, Taiwan up 13%. You have areas like India with longer term favorable earnings growth and demographics. You have areas like Europe doing massive fiscal spending. That's really helped their defense, their industrials, their banks, even in terms of how we've seen the yield curve normalize over there. Japan, you're seeing both this campaign of corporate shareholder reform, but also that fiscal story. Maybe not great on the bond side, but it's been better on the equity side. So there's these multi-pronged stories. They're pretty diversified from each other, and they do give again this legs to this rally that's not just, well, the dollar, the valuation story. If it were just that, I'd be a little bit more nervous about it, but I do think that's why we're going to see some persistent competitiveness from international. Doesn't mean we have to go all in, but it becomes just yet another lever in the portfolio that we can pull more effectively. Now, on metals, directionally, you can make the case that gold has gone up and silver has gone up because there are geopolitical risks. So people are hedging. Inflation is persistently above trend, so it is another hedge from that perspective. You've seen on the gold front, there's been more central bank buying and demand. And from a silver perspective, it is an important input in renewables, EVs. Think about some of the aspects of AI as well. It's an important commodity. So, directionally, yes, that makes sense why gold and silver would rise. But if you think about the magnitude and the speed of their ascents both over the last year, that's where it makes a little bit less sense to me because it hasn't gotten geopolitically worse. I'd say it's stayed tense across the world, but I don't think it's gotten all that much worse in 2025. Maybe tariffs, sure, but we've also seen how tariffs can be negotiated and walked back. So I don't buy into that too much. Inflation expectations haven't changed that much, and inflation is above target, but it's not spiking. And so central banks are buying. There's definitely that demand, but they're not like hand over fist. It's not necessarily justifying quite the rise that we've seen. So I do feel slightly nervous there in terms of how quickly we've seen those markets appreciate. And I do fear that there are some speculative aspects of that, not only from a retail perspective, maybe from a hedge fund institutional perspective as well, that I would be a little bit weary of.
No
Very
doubt. Yeah, it's
interesting.
hard to buy something that doubles. qu- uh,
Yeah.
uh, uh, So. What one question we get frequently from clients, it's always in the kind of the top five, and it's some derivative of what really should we be worried about with, for we can't look out 3 4 years with a lot of clarity, but for 2026 specifically, what do you worry about in the market for 2026? What could upset the apple cart?
So I do think, and you kind of alluded to this earlier when we were talking about the Fed, that growth may be quite strong this year. If
Right.
growth is strong, that often means inflation is strong with it. So that could create some additional inflationary pressures. And we know that has had a negative feedback loop into the consumer when we think about higher prices, affordability, sentiment. So I would flag inflation taking some time to get to 2%, extending that time frame as a risk. um, we're grappling with another government shutdown, so I think that the ebbs and flows of politics will continue to be a challenge. And the debt and deficit is still high. It's not likely to get any better in the next couple of years. Do I think that's a 2026 risk? Not necessarily, but there's still that lingering impact to some upward pressure on yields. And then you think about AI, and we're already seeing it in parts of the market. But if people really lose faith in the theme, or there is some sort of moment where people are losing faith in, maybe large public companies where some of the commitments have looked a little bit less on solid footing, that could create a reversal in some of these AI pockets, and that would be a challenge because even though you're seeing diversification within the theme, it's still bound up within the theme itself. So I do flag some of those as potential risks for 2026.
No doubt. Anything?
I was just
Yeah.
gonna one kind of quick piggyback on that was just in terms of the job market. We've seen, I think, a gradually weakening job market over the past handful of months, and I wonder, is that more of a correction back to maybe some of the hiring excesses and whatnot that we saw through the pandemic? Or do you think that, the impact of tariffs and some of maybe the broader, administration's policies, maybe they're impacting the market, job market in kind of a more direct way than maybe initially expected?
I think that's a good flag too in terms of the labor market. While some of the data looks like it's stabilizing, at the same time, the data that we were supposed to get in 2 days' time, again, timestamp, in 2 days, we were supposed to
Yeah.
get a jobs report. We will no longer be getting that jobs report. It's yet another disruption to the string of data that we need to make interest rate policy and to have a good perspective on the economy. Um, there is a risk that the labor market does weaken more substantially. It is already weakened, and it's not a self healing mechanism either. Whereas some areas like inflation and tariffs could be more transitory, I don't know that labor market weakness typically is. I will say on the AI front, I don't know that AI is displacing jobs actively as much as it is displacing the idea that you might need to hire because you could use AI in the next couple of years. So if you're a large business, you may continue to hire as is and think, well, in 3 years when we have the appropriate attrition, maybe we won't rehire for this role if we have a technological solution. If you're a smaller business and a smaller practice, then you may think, well, every one headcount is a massive change to my business. So I'm going to hold off because I might come up with an AI solution to take away some of the work off of myself and my employees. And I don't want to bring someone on with the expectation that they're going to work here for 10 or 15 years if I potentially don't have that need. So I think that there is that dynamic there, and that's impacting the younger segment of the population. But at the upper end, you do still see that people are getting hired for big jobs in banking and tech. So it's if you're able to drive the bottom line right away, great. But if there's a possibility that you won't in a couple of years or your services will no longer be needed, it's harder to make the case to want to hire. We're also seeing that overall labor supply has been somewhat constrained by some of the changes around things like immigration. There's just fewer available workers. So that has helped to keep this lower demand environment in check. But again, how long can we exist in that sort of tenuous equilibrium between lower supply and low demand?
At least anecdotally as well, it also seems like AI is a convenient tool when it comes to layoffs, right? It's kind of a good, in the same way that
An
it's a
excuse?
catch-all for
Yeah.
opportunity. It's a good
Yeah.
excuse for, hey, it's just, we're increasing efficiency every day, so we don't need as many folks, whether or not that's true, but at least that's kind of how it seems to come across sometimes in the news wires.
Yeah, I heard the term AI washing.
Yeah,
Is
yeah, exactly. It used
right.
to be how many times
It's
could you mention AI in an earnings call? Now
right.
it's how many times can you use it as a
Gonna have to let
justification
you
for.
go. It's AI.
Yeah.
We don't have any AI yet, but we're just
We
gonna
might.
have to let you go.
Yeah,
Exactly.
you still got to go.
Mira, so we'll start wrapping things up. Anything that's on the mind of investors that we didn't ask about?
The other thing I would mention, and maybe this is a good place to wrap,
Yeah.
is when you think about risks, we're always thinking about the downside risks. What could go wrong? What could fall apart? There's all of these reasons to be fearful and have anxiety about the markets, but we rarely think about upside surprises. And I think if you look at the entirety of this decade so far, it has been filled with upside surprises. Don't get me wrong, there've been plenty of headlines, scary stuff, disruptions, been a lot of bad. But you look at the economy and the markets, and you've had upside surprise to economic growth basically every year since the pandemic, and upside surprise to markets basically every year since the pandemic as well. And the big upside surprise last year too was that upside started to broaden out internationally as well. And you had equity like returns in the bond market where bonds were not looking so good for a couple of years. So I do think that it tends to be one of my colleagues has a great phrase that is pessimism sells but optimism pays, and I do think that's a helpful mantra when we think about investing and our outlook for the year ahead.
I love that. Always good to have a reason to be excited.
Yes.
Yeah, we don't get that question.
No,
We really don't get the
it's not.
question. Your clients aren't calling and say, "Hey, what's the upside surprise?" So it's a great point. Yet, if you look, I was just looking for my slide from this morning about we're more than halfway through earnings season, and it's an earnings surprise season again, right? So earnings are coming in, um, above expectations and at a double digit number, but that is an upside surprise. Well,
Yeah.
well, thank you.
Fifth
It's great to
consecutive quarter of those double digit earnings growth. I mean, unbelievable.
exactly. Well, thanks for having you. It's great. One of the benefits that Dan and I talk to clients about is that the benefit of being an independent firm is that we can rely on a great partner like J.P. Morgan, and we use J.P. Morgan for our clients, for asset management, but we also for this global market insight team, which is fantastic with all your hard work and your slides and your research. So we appreciate your partnership. Thank you very much for your time, and
Thank you.
we'll stay in touch. Dan, any last comments?
No, I would echo that and just thank you so much, Mira. It was wonderful conversation today, very interesting, and I know our clients will get a lot out of it.
Yeah, and hopefully, we said twice that we timestamp this thing. Hopefully, by next call, we do these mirror once a month. Hopefully, the snow will be melted in the New Jersey, New York area
I'm
That's
by
the
not
then.
hope.
holding my breath.
Yeah.
Yeah.
When you look at the extended forecast, it looks like we'll still be snow covered by the
If there's
webinar
just
next
one
month.
above 40-degree day or maybe above
Right.
35, I would hope for the next month that's my goal.
Yeah, it was funny. The other day, I think it was, maybe yesterday, it was like 35 or something for a brief period with the sun was out, and people people are ripping their coats off, right?
Bring on spring. I'm ready for it.
Yeah. So great. Thanks for your time. Have a great day.
Thank you.
Thanks,
Take
Mira. I
care.
appreciate you.
Thank you.
Take care.
See you.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors LLC, an SEC registered investment advisor. Concurrent Investment Partners LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.